Okay, why don't we get underway? Thank you all for being here. Thank you. All right. Thank you all for being here at the kickoff for what I think, Mark, is the 14th vintage of VentureCrushFG, which is part of this Venture Crush event series that we started here in March of 2000, we believe, and I'd love for someone to let me know if they think they have better data on this, because it's hard to research, at least for me. We believe it is the longest continuously running New York-based venture and startup event series, starting in March of 2000. We started this during a crash. We've done this through several crashes. We'll talk a little bit about some down market dynamics. Not that we know anything about down markets today, because that's not relevant. But we're going to talk today about funding your company in the first and second round. I'm going to do a little bit of setup and explain what our VentureCrushFG program is, because since 2008 in New York, we have been taking companies through this program. We do not take equity or charge or require you to work with anyone else or to work with anyone. We don't require you to pitch, and there is no demo day. It's about building community, and we hope that the founders in these companies will consider each other as part of a collective, as part of a community, and will help each other, not just in and with this company, but as leaders in the startup community on a go-forward basis. And we also really appreciate support, long-time support from venture investors who participate in the program, network with the companies. And part of why we don't do a demo day is we understand that often with demo days, which serve super important functions, companies get stack ranked by the investors who are coming to check out the demo day. And when that happens, you know that you're sort of building on a timeline for a demo day, and you also know that you're going to be stack ranked with the person sitting next to you. That can sometimes lead to a different dynamic than the one that we're trying to engender here for the VentureCrushFG program. So a couple of other quick notes. We have also our partner Meredith Bushaw is continuing our Women in Venture series by and for women. The next one is June 15th at 2 p.m. and that's going to focus on employment issues. And there are a whole bunch of things in the chat for those of you who are tuning in remotely by Zoom. And there's other information there on some other events. We're going to do this part for 90 minutes, maybe even close to 2 hours. We'll try to get some Q&A from the audience. A number of the questions that Alana and Richard are going to field come from the founders in the new VentureCrushFG vintage. Those founders submitted those questions within the last couple of hours as we sat in a room together and talked about the toughest issues that they're tackling. And they had some really interesting issues and experiences with fundraising. All of those experiences positive, and we want to talk about that and create an opportunity to maybe correct some perceptions that are floating around out there. As always, because investors are people, and we want context on people, and getting together in this kind of space is about getting to know one another a little bit. We're going to start with some background information, and I will actually start with Alana. You want to tell us a little bit about Springbank, but then I've got some questions for you about your background. And I'll sit, but tell us a little bit about yourself and Springbank, and then I'll ask some questions.
Sure. So first of all, it's great to see everybody. I was in one of these rooms long before COVID for another Venture Crush, and it's nice to be back in person with everybody. So I'll talk a little bit about Springbank first, and then I'll explain a little bit about how I, as someone who perceives myself as a bit outside of the venture universe, ended up running a venture fund. Springbank Collective, we're an early stage fund based here in New York. We focus on pre-seed through A. We're very thesis driven. Our focus is what we see as the missing infrastructure for working women and families, which we see as, multi-trillion-dollar opportunity kind of hidden in plain sight, which I think probably COVID made particularly clear for many of us. So we invest across 3 themes. The first is inclusive work. The second is the care economy. And the third is household consumer. Our typical check sizes are, $250 to $1 million. We sometimes co-lead or sometimes parts of rounds. I particularly lead a lot of our care economy investing, which I think is both sort of the most interesting labor market challenge right now. It's also, sits at the heart of how we care for all of the folks that we love. So I never tire of talking about that space and some of the trends there. In terms of my background. In terms of my background, I actually come from politics and policy in another life. I was one of the first couple hundred tech folks in the Obama administration and have kept a hand in politics and policy since then, which is pretty handy since I personally think that the next generation of sort of definitional companies are all in some ways going to encounter public policy. So it's useful to understand it. I spent the last 5 some odd years investing and advising with Eric Schmidt's family office on the impact side of the house, former Google CEO. So every type of capital. I've been a social entrepreneur with one exit in voting technology and have been around sort of social impact and entrepreneurship for my whole career.
And when you say voting technology, you were
I did not make the Dominion voting machine. I don't know.
You were helping with Russian interference.
Yeah,
stimulating.
Obviously, as Ed knows, I'm in fact married to a Russian. So this is my friends and I built something called Hello Vote. It was the first time you could register to vote in the United States end to end via Facebook Messenger or SMS. Mostly because we just wanted to see if we could. I mean, it was sort of a social impact venture, and it involved every state has different regulations. So we basically built 50 chatbots, and we're kind of kicking ourselves the whole time. But it was fun.
While you were an innovator in residence for CARE, which is one of the world's largest humanitarian organizations, you launched a refugee filmmaking.
That was truly accidental because I'm not a filmmaker. I enjoy watching films. So CARE, I used to work in the State Department when I was in the Obama administration for a while. I was an innovation advisor to the Secretary of State. And a bunch of folks after who were at State and USAID left for CARE, which is, as Ed said, one of the world's largest humanitarian organizations operating all over the world. And I started just on the side helping them out with some tech projects. And a bunch of us went out to Azraq, which is a refugee camp in Jordan that serves Syrian refugees. And originally we were actually there to work on an incredibly wonky CRM refugee data project. And actually we got there and it was pretty clear that the actual kind of the hacky workaround that everyone in the camp had figured out was going to work a hell of a lot better in a low bandwidth environment than like a heavyweight CRM solution that people didn't need. And I was still there like pregnant in 104-degree weather for the week and wanted to be helpful. And we started talking to all the kids there and they all had cell phones of varying quality. They'd actually all built their own solar cell phone charging station in the middle of the camp. And they said, we know how to tell our own stories. So, teach us how to use some editing equipment. And I thought, probably. Anyway, so it's now had a couple of iterations, but so the kids of Azraq have been making short films on a bunch of different devices now, which has been really cool. And frankly, all of the 7-year-olds in Azraq camp know more about filmmaking than I do.
So one of the things that didn't come out when we were doing diligence on you for First Close Partners, which is the fund of funds that I started with a couple of friends and through which we invested in Springbank Collective pretty early on.
Our very first check.
We like that. But we diligenced you over 2 years ago, and there was something about bad reputation and you that we did not find then. So we found it for today, though.
Oh, God.
And so you've published in NPR, New York Times, Time Out New York, The New Republic, a bunch of other, left-wing journalistic outlets. But it is your Salon article from 2003
Oh my God.
that I'm going to quote from, because one of the things that we like to do with Venture Crush is to spotlight people who really are competing in a world-class kind of way. And the quote that I have here is, 20 of us, all contestants in the first annual United States Air Guitar Championship, were crowded into the top floor of the Pussycat Lounge, a dingy nightclub in Tribeca with a seedy nudie bar on its lower level. I've chosen Joan Jett's bad reputation. I flail, I thrash, I shake, my glasses fall down my nose. I know that feeling. My hair plasters itself to my sweaty forehead. I look like I am manhandling a bag of invisible eels. I'm
How did this prepare me for a career in venture?
Well, first of all, like with writing like that back in 2003 and a performance deemed horrible by one of the judges and terrible by the other, according to your article, by the way, why give up the writing? Why give up the air guitar champion status?
I had the reason that was particularly humiliating. So thank you for
That's why I'm here.
You know, they paid, I think I got paid like $75 to write that article. And at that point I was working at an activist organization, and anyone who was going to let me publish in their pages, I was definitely going to take them up on. But, you know, part of writing, and actually maybe later I will tell the story of how I paid for business school off of an adventure that came out of a different, slightly less embarrassing article. But, you know, you basically get to spend all day talking to interesting people who tell you their life stories and who are probably smarter than you. And that is a lot of what getting to work with entrepreneurs is like. So that part has continued, and I'll keep my sort of haiku writing to a more private space for the short term. So,
okay,
thank you, Ed.
Rock on.
Yeah.
So, Richard, you want to tell us a little bit about yourself and Equal Ventures?
Sure. Richard Kirby, a partner at Equal Ventures. We are a seed stage focused firm here in New York. Think of it as a founder raising $3 to $5 million, kind of our sweet spot. We're generally writing $2 million checks in those rounds. And so leading those rounds, joining the boards. We are a generalist firm, but skew more B2B than B2C. And then within that, there are a couple of categories we've spent extra time in. So think of things like e-commerce enablement, logistics, supply chain, care economy as well, with a lot of stuff that's bringing together. And so that's kind of where we sit. Before this, before founding the firm, I was an investor at Venrock for 5 years, focusing on tech at the seed and Series A stage. And then before that was at a later stage fund called IVP. Check size there was more than the $30 million range. And you know, companies I worked there, companies like Dropbox, Shazam, Fleetmatic, CX, the Popsugar Network. So that's me. Way less interesting. Thankfully.
I'm sure you found something embarrassing on the internet, right?
No, I saved that for you.
Okay. Thank you. Appreciate it.
So you also, before IVP, from June of 2008 to June of 2010, you worked at Credit Suisse.
I did.
And
right.
I can't help but notice that in August and September of 2008, the market went to hell in a handbasket.
Correct.
And I'm just wondering, you know, was that a very perplexing time? And are there things that you learned as you were kind of starting out and walking into a market that was fine in June of 2008 and terrible in August, September of 2008?
Yeah, I mean, not, I guess, crazy to some of them now, I guess, but saw how excess spending can go the wrong way. I think when we, like our intern class, I think they took us all to like bed or catch and meatpacking and like bought the whole place out. And that was like just a great use of money at the time, in their opinion. I had a great time, but turns out that led to erroneous spending and then eventually many folks getting fired. I also learned that though, like executives get fired before non-executives because they're just more expensive, which was interesting to see. And then I also learned, I fortunately wasn't like this, like I think we had 3 waves of layoffs throughout that time they were there. And I learned from my friends that you actually want to be in the first round of layoffs because that's the biggest package you can get, basically. And so for those who may see companies teetering that you're working at, if you are, get in that first wave if you want to. Folks also volunteered to be in the first wave to then have money to then start their next company as well. And so saw that play out, which I'm seeing kind of playing out right now as well again. And then the one other thing, maybe not relevant, was I remember when we were being recruited by like some like COO of Credit Suisse, how like loyalty is so important to an organization. And between when I signed my letter and we joined, he had quit himself for a job that paid him more. And so Not saying don't be loyal to your company, but just think about what those above you are doing to sell you, because at the end of the day, they're selling you for a purpose. And so understand where they're coming from in that context. So yeah.
Okay, we'll come back to some of those learnings. You also created something called stealth mode.
That's right.
Which you don't necessarily talk so much about stealth mode stuff. You did, however, in TechCrunch in 2015, announce it, and you created it with Charles Hudson, who is not only the founder of Precursor, but just became the new
NBCA
head of the NBCA, which is really cool. So you want to talk about what stealth mode is, or is it too stealthy?
No, I mean, it's an article in TechCrunch, so it's not that stealthy, I guess. But yeah, so it's basically a pseudo organization that Charles and I created back when I was in the Bay Area to support Black founders, operators, investors within tech, broadly speaking. And so we started out with the SF chapter, really, really small. I think there was like 7 of us originally and no women, which is ridiculous, but we've kind of fixed that now. And now we've got chapters in 3 cities, SF, New York, and LA. And it's called 1,500 or so African-American operators, investors, founders, et cetera, all trying to be effective in the community to support each other across various mechanisms. So folks have raised money within the community, found co-founders, received jobs, had exits via the community as well. And so it's just like a community we all built to support each other and kind of runs pseudo autonomous at for them.
And how can people get engaged there?
You ask me. That's the stealth part, I guess.
That part hasn't changed.
Has not changed.
Okay.
No.
So ask Richard if you're interested. All right. You also, so in that article, you also talked about why are there so few Black investors in venture?
Mm-hmm.
That was March of 2015. In 2016, you followed up in TechCrunch and wrote about the numbers, and you did analysis. And then in 2018, you updated the numbers, although not much had changed. And you posted this great piece called "Where Did You Go to School?" And there are some metrics in there. You have not updated it since. Those were really important pieces of tech and venture journalism, and powerful pieces. And you shared on an open basis your data set. You want to talk a little bit about what you found and maybe how that impacted you individually?
Yeah, I mean, so I did the analysis knowing what the answer was going to be. I just figured that folks generally don't listen as much about things they don't care about until they see data behind it. And so I figured everyone knows there's a dearth of Black investors in venture capital. I don't think that's like a non-obvious statement, but to what degree I thought was important to demonstrate. And so went out, surveyed a couple hundred venture firms to get over across several thousand investors to get the data sets, and effectively rounds to roughly 2% of the venture ecosystem, regardless of just title, right? And obviously that's not reflective of what the US economy and population looks like. And so that by definition didn't really make sense to me. And so I thought putting data to a pain point will actually get people to start acting on things, which I think is true. I think folks have acted since then. To a degree that I would like them to do, I'd say no. Still plenty of work to be done there on that front. And there's always these like moments, whether it's that article, whether it's the murder of George Floyd, that catalyze people to do things, but to create sustained movement, I think is very, very challenging. I don't think either of those things have sustained. And so it's important to continue to kind of highlight, share more data, and I think just share action plans too, which is important beyond just like calling a problem, try to provoke solutions as well. And so there's a lot to be done there. I think it needs to be across multiple fronts. I myself or anyone else is not going to do it on their own. And so it needs to be a multi-pronged effort, I think, to solve what I think is a problem.
And some parallels in the data. So I published something in the Wall Street Journal in 2013, and I published a companion case study at that time at Columbia, where I've been teaching venture capital. And I know some of the people in this room are former students who suffered through my teaching of that case study. But there was data that I cited there, which had been collected in 2011, that was 89% of those who identified themselves as venture investors were male. That's in my 2013 article. Your 2018 analysis found 82% being male. So slightly different, but still really lousy. And we also had some similar results. The NVCA survey data showed 52% of VCs had degrees from 10 schools. And you found that 40% of venture investors had degrees from Stanford or Harvard, just
Two schools.
two schools,
Yeah.
and that more than 50% of Black investors in venture had degrees, unsurprisingly, from those two schools. So I won't bore you with other stats, but suffice to say that my 2011 data and your 2018 data were really overlapping. And one of the things I did with your data set when it came out was I searched for HBCUs, and I found Howard 11 times in your data set of 1,500 or 1,800 VCUs. It only appeared as a first name or last name. There were, I think, no HBCU alums in that data set. And we have seen a change. Are people coming back to you because of those pieces of writing? Are they kind of, continuing to have people come to you to talk through what's going on and how it's changed or not?
Yeah, folks definitely reach out to, one, ask for more data, which I'm like, I can do it, but it's going to be very similar. Two, to think through proposed solutions, and three, to just like find talent. I'm only one person, can only get talent so many ways, but I'm happy to be a conduit if I can be helpful in that respect as well. But I think the point around where you went to school is, I think, pretty important. I think when you're in this, non-consensus demographic, whether you're Black, Hispanic, a woman, the traits required of you are going to be higher, which is why I think that 50 or 40% of Harvard or Stanford actually over-indexes even higher for if you went on just the female investors or just the Black investors. And so it's if we're going to let you in this crowd, you have to actually have more degrees than I do, at better schools than I do, to be enabled the affordability or access to this industry, which I think is also ridiculous. I think there has been movement on the HBCU side. There's a couple of programs that I'm a part of that help to, one, educate folks on like it as an opportunity, and two, place them and embed them in scenarios where they can get roles in the industry and succeed. And so definitely things are happening, but it's also at like, smaller scales. Like these programs probably are 20-ish students per program. And so when you're thinking about a data set of thousands, it's really hard to fix that. Similarly, if you're a startup company and you don't care or think about having a diverse set of employees until after you're at 50 employees, it's really hard to fix that. Because you already built in either culture or demographic that doesn't reflect that. No one wants to be the first woman at a company or first woman on an investment team or vice versa. And so all these things, I think, are self-fulfilling and make it harder to change the problem. So I think it needs to start, one, from the top, but two, also to think about it when you're starting a fund, starting a company, or starting any organization in general.
Yeah, and it's similarly challenging to be the first female-led or underrepresented-led portfolio company of a fund that has 100 portfolio companies.
Yeah, that's right.
And so those are some of the dynamics that make fundraising, different for different people, but challenging. Let's talk a little bit about fundraising. We asked the founders what questions were top of mind for them. I'm going to start with one that I think sets the stage for the current market. There was a question: when is a pre-seed investor going to again be a pre-seed investor? When is a seed investor going to again be a seed investor? And you can start by explaining what you think the question is. I think it's a fairly clear question if you're, in it every day, but maybe less clear if you're not.
Sure. So, I think at least from where I was sitting, and obviously, we're investing out of our fund one now. So, in 2021, beginning of 2022, especially in like some of the, at that point, higher velocity spaces that we look at, including, digital health and some fintech, I was seeing seeing a number of seed rounds that I would have previously thought of as being a pre-seed, right? It's an idea, it's a founder, it's a founding team, it's a couple of slides, it's an interesting space. It's something where you think like, okay, I want to see more. And it was sort of, being priced at 40 million post or 50 million post, which, I think is a trap, because then you have to raise a Series A now. And so, I think we are, at least, from where I'm sitting, outside of a couple of spaces like generative AI and climate, where I think valuations have stayed super durable. I think like we are seeing round sizes and prices come down a little bit, but they have not sort of equalized in terms of how much A's and B's have come down. So I still think, there's a bit of a gap. So, I am seeing many more pre-seed rounds getting done at sort of prices that remind me more of 2018 instead of 2021. And the same with seeds. I do think, and actually this goes a bit to some of the things we were discussing around access and equity for underrepresented folks. One thing I've been thinking a lot about at pre-seed and seed, because obviously right now, I think a lot of people are feeling kind of risk averse, or as someone put it, I don't want to be the one to catch a falling knife, in terms of sort of where the bottom is. One thing we think about a lot is who has the privilege to come to you pre-seed with something that is pretty built out, which is to say who had spent, 10 years at Google and has enough personal runway to build for 18 months before they try to raise, and who could raise a friends and family round, because they have friends and family who have $10,000 like spare change in their pockets. So I'll say too, like something just we think a lot about as a firm is we take founders' personal stories and where they come from and the grit that and hustle they have along the way as sort of individual cases. And so sometimes, what we look for at a pre-seed might look different for different kind of teams who had different amounts of runway before they walked in the door.
Yeah. I think like every investor probably defines pre-seed and seed super differently. I think the earlier you are, I think the more narrow actually your investor outreach should be. I think like on the pre-seed side, I would almost like limit to like the investors, if you know any, ideally those folks. Then two investors that have explicitly stated either implicitly or implicitly that they want to invest in your category. And so like, if you're looking to raise a pre-seed round for a e-commerce enabling company, don't go talk to someone who invests in nuclear fusion. Like you're wasting your time and their time. And so I would kind of like narrow it as much as possible to folks that have like opted into your category. And that's assuming, once again, maybe to Lana's point, that you even have access to these folks. And so like, fortunately, folks are more public with their personas now, and you can find alternate avenues to reach out to folks, but it's definitely difficult in that respect. For us at the seed stage, which we do like all investing there, so we don't really even done any pre-seed to date, but at the seed stage, we're trying to figure out like, is a company roughly 12 months away from being able to demonstrate product market fit in their category? And it's a bad answer, I guess, but like it varies wildly per company. Some companies can be there at like incorporation stage. Some companies it takes 3 years to get there. And so that's been like the dearth of stage of company investing. We invested in a company that wasn't incorporated. We've also waited to a company that was 3 years old to raise a seed round. And so it varies wildly. Not an answer I think founders like hearing, but like that's honestly how we think about it.
And I was gonna say we have a couple of pre-seed checks in, where we wrote the check before founders had left their jobs. Or I guess technically when the cash hit, they had left their jobs. But where we, and in those cases, these were folks where we really thought they were like the absolute best in class person or team to be tackling the thing they were tackling. But that is not like the majority of checks we're writing. I think, the kind of milestones, though, obviously they're very industry based. So for instance, like, we look at a good amount of healthcare. And if you are, we tend to not be as excited about cash pay healthcare. Most Americans cannot afford the care that they need. So that means, obviously people are doing things like insurance integration. The idea that at the seed stage, we're going to see a lot of revenue traction and a bunch of like contracts turned on is not realistic. If it's, we're in a company where we invest in the seed stage, it's like a kids nutrition company, and, they were at, $1.5 million in revenue 2 seconds later, because it was, it's just a totally different business model. So we have a different set of benchmarks on a sort of per category basis where we think that the revenue models are really different. So I think trying to line up I think, there's lots of these kind of pitch booky articles that aggregate data like across around, sort of seed stage, when I think that the more relevant benchmarks are going to be, within your category.
So let's go back to that kids nutrition company that's at $1 million and change in revenue. How long before it releases product are you willing to invest?
For us, we don't do a ton of CPG. Like, we think of our household consumer product category a little more sort of, where women sit as the chief purchasing officers and CFOs of the majority of households in the US, kind of what is the tooling that they need to do that faster, better, cheaper. So a lot of things we invest in that category of software. Frankly, like, if we can't, especially in children's nutrition, my child was my guinea pig, who's 5 and really liked the product, but we don't typically invest in CPG. We don't do that.
All right, so scrap CPG, but talk about like software or technology where and I only use that example because you mentioned $1.5 million of revenue, and that's a terrifying number compared to what the pre-seed market was from some point in 2020 to some point in 2022.
Oh, 100%. And to be clear, like, I think CPG, like D2C CPG, has like a completely different revenue expectation, and you also see it later in the multiples, right? I mean, it has a much lower multiple on revenue, so I think it's a lot different. We certainly in our firm would not write a seed stage check, though I was seeing a bunch of them go out in 2021 when there is no product that I can at least play around with. I saw, I think sort of seed rounds without a line of code written are not where we invest. Our check sizes are not big enough to go along for that ride. We don't have anything super hard and fast. We're investing at the seed stage. We want to feel like you really understand your market. You have some insights towards product market fit. You might not be there yet, but we also, like, one of the things that's really important to us is sort of how fast is your cycle time to ship. Like, I don't expect product market fit to be there and be perfect, but I want to know that the cycle time for you to keep shipping and testing things out is going to be really tight and fast.
So you've both mentioned product market fit. What is it, and how do you know when you're there?
Sure. Yeah. Once again, I think it varies by company. And so imagine the CPG example there, you can just look at data to determine it. So repurchase rates, basket size increasing, your cost to acquire that customer. I think some of those are applicable to other industries too, but very specific to there. I think if you're talking about a traditional software business where you're selling pure software, I think really understand the speed on sales cycle. Like, it should be shortening, not extending, and then your actual ACV on that should be also expanding. And that shows you that, one, it's getting easier for you to sell because the market pull is saying we want this product, and therefore that's showing product market fit in some extent. I think the piece on the ACV side, you've now demonstrated that you can either capture a larger portion of the employee base as customers, or the value that you provide to that end customer is greater than it initially was. And so that also enables you to kind of grow in that standpoint. And then on a, consumer social side, I think the metrics there are more tied to engagement. And so, how often are folks using something? How often are they coming back? For how long is each session? Those are the metrics I would say in that camp. So those are like 3 different business types that we would think about in terms of product market fit. But I don't think it's like, for us, it's not like get to $1 million of ARR and you've proven it. To us, it's more of like, show us that your customers love it, more so than what the revenue metric actually will be. Because those are also questions that we know, more importantly, what the Series A investors are going to want to see. And so at the end of the day, if you're raising a seed round and have to raise a Series A in the future, the answer is, what does a Series A investor want to see? And I think, yes, they have top line metrics they want to see. I think that just like gets you in the door, but the actual like sales cycle and product usage is what gets them to get actually excited to write a check, and hopefully write it at as less dilution as possible for, said founder.
Yeah. And I mean, I look a lot at retention. I don't care very much about the sort of wait list, like super top of the funnel stuff, but like, month on month retention and usage numbers for things that have, I'm happy if anyone's a healthcare founder, I'm happy to like talk later specifically about some of like the, when you're contracting with plans, gnarliness of what we might look for. But, I think also really looking for, that if you're contracting with big, slow customers, like we have a company in our portfolio that sells through governments. And, one of the things that really sold us at the seed beyond like some amazing, like really, amazing usage and retention numbers was that every time that they were pitching a government, they were cutting their cycle time from like first conversation to approved RFP in half. That just suggested they were getting really, really good at doing something really hard, and that they actually were understanding a thing that governments had a big pain point around. So seeing that sales cycle time go down and down and down was important to us.
So this may sound like a strange question, but was that a slide in the deck? And I'm asking because like you can actually show demonstrable progress by showing that as you're moving along, your sales cycle is, there are specific points in the sales cycle and it's getting shorter and shorter and shorter, which is a really big deal. Not all slide decks have the same ingredients. Is that something that they showed you as a visual?
No, they did not. I had to walk it through with them. In part, actually, because they landed one of these contracts 2 weeks into starting the raise. So, yes, it should have absolutely been a slide.
Not saying it as a criticism, it's an opportunity. And one of the questions that the founders wanted to know was, what do you actually want to see in a deck? How much do you need to see about the company, about the industry? How much do I have to load in there about the sector, especially if it's not a sector that you're very familiar with?
Yes, I actually don't really care if that metric's in the deck, honestly, because I think like the deck for me is more to like get a higher level viewpoint of what the company is. And so like to answer that second question, it's like, okay, 1, what's the market you're in? 2, what's the problem you're solving? 3, how are you solving it uniquely? And 4, I guess, like, is it working however you define working is? That's like, to me, more important. And like, I will then figure out the sales cycle unit economic data if that first step intrigued me or not. And so I think like, because it's really hard to like, I don't know, say no one. I wouldn't want to go through your sales cycle and your economics in like the first 30-minute meeting, because I want to first understand like why you're doing it, what you're building is so important to your category, whether it's consumer or B2B or not. And so first, like, let's level set and align on what you're building is a fit for us. And then we can figure out like the data piece later on. Because once again, I think the ultimate Series A goals aren't necessarily going to be the top piece, at least for us at Equal. And so we focus more on the other non-revenue driven product market fit metrics, or I guess criteria that I mentioned before. I think you want to first get folks hooked on what you're building before like spending a ton of time on data. Now, for investors who may not know shit about what you're building, yes, metrics help them get excited from a growth and traction perspective. So you can utilize that as a mechanism. But then the question is like, do you want someone who doesn't know shit about your category investing in your business if you have the opportunity to choose from more than one? And so those are things that we try to have our founders think about as well.
So one thing we're always very interested in, everyone has kind of the founder slide that has fancy logos on it, and do that. I think we're pretty interested in like why any given founding team is uniquely positioned to be the team to have founder market fit with the thing that they're building, and like that takes lots of forms. Sometimes it's that you maybe blew out of the water like another marketplace that you worked on that had really different dynamics. In some cases, it could be some lived experience that brought you to a deeper understanding of a problem. But I always like to come away from a deck with some sense of that, and obviously it should come out in the conversation. There's actually a founder who I'm tracking very closely right now who's building something I'm really excited about. And honestly, he never mentioned to me. I kept wondering like, wow, how has this person figured out this very specific problem? And he never brought up the fact that his parents had worked in this industry his whole life, and that every member of his family worked in the industry. And part of me is like, maybe you should put that up front or, mention it. So I like to see that. I think everyone has, the TAM slide, and the TAM slides sometimes get increasingly ridiculous, right? Where you're like, every human on earth might one day want this thing. I think like I would say using some good sense about, look, if your market is clearly niche, then you need to also explain to us why it's going to be crazy sticky and the LTV is going to be ridiculous. So, obviously TAM does matter, but I think, and I say this lovingly as a former McKinsey consultant in another life, right? Like anyone can make a TAM number that sort of tap dances and does your laundry and will do whatever you need it to do. So I think some of it is seeing like, are you thoughtful enough about your own industry to understand how you would slice and dice the number? Like if you tell me in the care space, my market is every person who's ever had an aging parent on earth, maybe,
Yeah.
TAM.
But I agree there too. I think like understand the competitive landscape. I think if you're the founder, you're gonna be living in the category day to day, not like a lot of us. And so like, or myself. And so like, you should know way more than we should know. And if we can like pose questions that are unanswerable, that's like dead on arrival. Like the meeting's over most at that point in time. And so I think that's important, understanding the category itself. I think smaller TAMs are fine. Just align yourself with investors that also work with it, right? So if you have a small-ish TAM defined by, maybe however the investor you're talking to is defining it, like don't go talk to a fund that's $1 billion size, because like they're not going to invest in you. Or if they do, they're going to want to do unnatural things from a growth perspective that actually may make it hard for you to succeed and exit at the time you want. Rather, looking at a firm that like might be $50 million or $100 million fund size. I wouldn't say any, but like almost every TAM in the world can work for a fund size that small. And so you've aligned yourself to someone whose outcome can coincide with you as well. And so I think in general, I try to caution founders to say like, you want to work with a firm or fund or person who, if you have an exit to your business and you are personally financially well afterwards, it should be the same for that particular investor. And if those aren't aligned, then you're probably setting yourself for failure with that investor set.
All right. So first of all, TAM, total addressable market.
Sorry.
I'm just making sure that we're all, and LTV.
Customer lifetime value.
And when you talk about, a small fund size, almost any size TAM will work. When was the last time someone actually like mapped out what the total size of the addressable market was, and it was less than $1 billion, and Equal or Springbank actually invested?
Under $1 billion?
Under $1 billion of revenue opportunity. We actually did one that was like 900, I guess. But like, we've now realized that we were wrong. It's way higher. So the thing there is that like, I honestly think, not throwing shade at myself or Lana, none of us know what the fuck these market sizes are, and including the founders most times, I would say. And so I think like TAM on the investor side is an easy way for you to say no. And the reason I think why investors try to whittle down TAM so much is because the slide always says $75 fucking billion. And like, that's just not true. And so folks are trying to do the math, try to figure out how small it actually is, when in reality, I don't think many of us even know how big these markets are. And so the more important piece to me is like, how many companies, if it's B2B, or how many people, if it's B2C, could this impact? And let's figure out what that might look like over time. I think it's more directional than factual, I think, because even if you look at IBIS reports on the things, like they're all fucking wrong. And so to me, and this is more unique to me here, I like underweight TAM on my like checklist of things to evaluate, way far below. But even if it's like, $400 million opportunity, I guess that's in theory, that's small. But if you're building a product that can monopolize that whole category, like if you build a business that can have $300 million, I don't care what the market is, it's valuable. And you and your investor sets are going to succeed with that outcome at the end of the day.
Yeah, I mean, I think, some of it is just like, does everyone have decent instincts about what makes for a ridiculous or non-ridiculous assumption? Like like I said, my post-consulting life makes me think you can make any TAM slide, say anything you want, but is everyone asking good questions about it? If you're saying that you get to an outcome that's interesting to us by owning 65% of a market that you currently have 0.5% in, like, let's talk about what you think is going to happen to get from 0.5% to 65%. But for instance, I can give an example of a company that, I think has a smaller TAM, but that, for us, I think is, very exciting given the entry point at which we came in. We're investors in a company called Plume. They're now the largest provider of trans healthcare in the world. The population of trans and non-binary folks is not enormous, right? It is not 300 million people in the United States. But we did think it was both sort of directionally growing, but that more importantly, that it was such a medically underserved community who are so sticky and with potentially a lot of lifetime value if they find a brand that is meeting their healthcare needs in a sort of responsive way, that we thought it was quite interesting for us. Some of this also is due to our fund size and the fact that we invested very early. So, we weren't needing to, I think the nature of probably where we all invest is, obviously everyone wants to have shoot for the moon outcomes. I think the nature of different fund sizes is, I have friends at really large mega funds who, especially like 2 years ago when things were a little wild, they were open about saying, if we can't underwrite a company to a $10 billion outcome, we can't invest. And like, I don't really know what to do with that, because I think we're all remembering exactly how hard it is to create $10 million worth of value, $20 million worth of value, right? It's remarkable. And so I think, we both kind of built our fund strategies around being able to work with companies, that I think can have more of a range of outcomes and still have a great return for our investors.
How did you recalibrate your mindset, Richard, when you left IVP? So IVP is this enormously successful fund that is a growth stage, has been for many years a growth stage investor in iconic venture-backed tech companies. How do you recalibrate from like, we're going to write a $50 million check into Dropbox after it's already raised a whole bunch of money, to no, we are seed investors and we sometimes show up as the first venture fund after, a bunch of angels have come into something?
Yeah. I mean, I just think it's a lot more fun. Like, so like the IVP stage, there's a lot more to analyze, but it becomes more of a math equation rather than like truly understanding what a market is, what products being built and why it's unique and differentiated. And that to me is exciting. And two, I think an investment at the seed stage can be way more helpful. Like when we invest in a company that's a Series C stage, I'm not saying they're a well-oiled machine, but like they don't need, a lot more of your help there. When I was IVP, like the model was like, we'll invest, probably won't take a board seat, maybe an observer. At the end of the day, like give me 3 to 5x in 3 to 5 years. If you need my help, call me. And that just is less fun, less exciting, and you can't learn as much. And so the calibration for me was just actually around learning more so than anything else, because the speed in which you can learn is a lot higher at the seed stage, because there are a lot more things that are fucked up, not fixed, broken, et cetera, as I'm sure founders can attest to themselves. And therefore, a lot more ways for us to be helpful and learn a lot faster as well. And I think, yes, maybe the return sizes are probably bigger because you're at larger checks in those scenarios, but like I'm learning a lot more than I did when I was at IVP, because like it was a skill set I kind of already knew because had done banking before. And to Lana's point on the McKinsey front, like I can make anyone's mouth say anything I want to say, just like you can. I can probably do better than you can actually. And so like, and can do the inverse too. And so that is just a different framework for investing. And I think it requires a bigger leap of faith, which I think you're trying to articulate too there, Ed, because like the later stages of the companies are established, they're going to exist, they're generally not going to go away. And so the risk profile you take there and the leap of faith is a lot less. And so here you're believing that like the vision of any founder is something that you're aligned to, and you think that it can get from, 0 today to something very meaningful in the future. And it's fun.
So you mentioned math and that, you spend more time doing math at IVP. And you talked about, all of these McKinsey things and TAM and, a whole bunch of acronyms. We talked a little bit with the founders before this session today about financial models, and for pre-seed startups looking to get their first check, they're being asked not only for financial models, but a number of them are being asked for 10-year projections.
Yeah.
I mean, like 2 or 3 people might have been, 4 people might have been.
Yeah.
Oh yeah. Okay.
Yeah. There, I see a couple. I see a number of hands. Yeah. So, other than just like basically calling bullshit on asking a pre-seed company for 10-year projections, what is a reasonable expectation of the kind of financial info you would expect to see from a company that is looking for seed or pre-seed funding in the current market?
I mean, 10 years is ridiculous. I think, so one thing too to note is, I think one of the trends of the last couple of years when everything was very frothy is we were seeing a lot of funds that had typically played in later stages coming more and more into pre-seed and seed markets. And, I do think I don't know. I mean, you spend more time obviously at a larger fund, but if you have to this point about saying like every stage round you go, there's more stuff to analyze, right? And at pre-seed, it's a lot more like, for me, do you love this founder? Do you think the market's enormous and they'll probably figure something out? And then at each round, there's a whole bunch, more stuff to put in your data room. And it's been interesting because I think as we have investors that are playing across all of these categories, I'm sure they're probably bringing some of those sensibilities to earlier stage. One thing is, I think one thing sometimes investors are looking for also is a little bit of like, a certain kind of professionalism in the approach to the fundraise. So like, do I think every seed round needs to have like a crazy data room with every contract you've ever had in it? No. I do think there's something that like when I see a founder who's been thoughtful about like what information they do have to provide, I don't care if it's in Notion or a DocSend or I don't care how you do it. I think to me, it just like there's a thoughtfulness that I'm often impressed by. And like, I'm typically used to seeing like, maybe a 3 to 5 year financial model. And again, some of it is just to have conversations to pressure test assumptions about growth, about margins, about margin expansion. From my perspective, especially at the really early stage, a financial model to me is just, the basis of a conversation, not sort of for me, kind of a go, no go. Because obviously, if you're in a software business with 80% margins, the way you're going to run that business looks really different than if you're in a part of like healthcare delivery that, you'd be lucky if it has 40. So, 10 years seems crazy. 3 to 5 seems, like something I'm used to seeing with the understanding that, is at a particular level of granularity. I'm not expecting you to have accounted for every light switch in an office you're going to have in 5 years from now. But again, I think it's directional. It's a little bit of like pressure testing business assumptions and like decent good sense, and sort of also showing. And the last thing, I think in part because of the background of me and the rest of our team, we love materials. But I do think one thing that was hard for us as a smaller fund sometimes in 2 years ago is that sometimes we get access to sort of very hot deals and founders would say, there's no deck, it's me. Do you like it? You have 24 hours, like this is your allocation. And that's not the kind of fund we run. And that is not the kind of relationships we like to have with founders. So I think there's something about finding something in the middle, which is, I need to feel respected enough that I've gotten to have my questions answered and that we've gotten to have a real conversation about the business. And also, like, I don't think any pre-seed company should have 14 like PE wizards sitting in the background doing models.
Yeah, and I generally agree with all that. I think like I get fundraising at a seed stage is incredibly difficult, but I think also your time is super valuable. And so I think like if anyone is asking you for 10 years of projections, like stop the conversation. They're never investing in your company. They don't understand your business. They don't understand the venture probably either. So like don't waste time with that particular investor set and move on, because your time is super valuable. Like you could use that time generating revenue for your business rather than like talking to someone who's not going to write you a check. I think on the financial model thing too, yeah, I think it's more of like just understand. I care less about like what the growth really is and more about like, how do I understand how your business operates? So like if you are a software business and I can see there that like your margins are like 30%, like you're clearly not a software business. You obviously have humans doing this, which is not necessarily a bad thing, but like it's good to understand that humans are processing it today. And maybe they're doing it today, so you can figure out what to automate in the future and grow that over time. And so those are just things that we want to know going into the business and investments, so that we know what to expect and what to think about and where you could use help. Similarly, like let's say you plan on growing from $500,000 to 2 to 4 to 5, whatever it might be. Like what assumptions, to Alana's point, do we have to believe for you to achieve that? And if we're like these assumptions are like impossible, then we're not going to invest in that company. But if they're reasonable and we think that could occur, those are the kinds of questions that are actually underlying there. What we've seen, I think 3 is probably the 3 years. Sorry, it's probably the average, or I think most. Because like at the end of the day, like Alana said, I can make whatever I want, say in 3 years or 5 years or 6 years or 4 years. And so it's really more about like what do you need to believe and how does your business operate? Whether it's in a software business, whether it's a tech-enabled service, they vary differently. And so understanding how your business operates is the point of the model, not like how you're growing and do we believe the projections.
And sorry, I was just thinking about a financial model I was looking at last night. Then there's sort of minor things of just like good common sense. I looked at a financial model that had a company raising a seed that showed that their revenue was going between Q2 and Q3 was going to 7x. would love that for them, would love that for me. I'm not in this, I'm not currently invested in this business, but if your revenue is going to 7x quarter over quarter, like there better be a story that is, there's some reason like you're about to get the Department of Defense as a client, you know, like what there better be. So I think there's some of that stuff of just like, you know, we all need to believe the story. And to this point about like this, what do you need to believe question, you know, and we still, you know, we write investment memos that we bring to our small IC to kind of keep us all intellectually honest on the team. And, you know, for us, one of the most important sections is this, like, what do you need to believe for this company to succeed section? And like in any investment that's early stage, there's going to be a whole bunch of open questions. And I think sometimes for us, it's like, how many open questions? If it's, you know, no one on this team has ever managed a person before, and there's FDA risk, and you need to believe that a regulation is going to change, and you know, so I think I don't think we've ever made an investment that didn't have, you know, a bunch of things on the what you need to believe list. I think there's a point at which, you know, if I need to believe like 15 things, that probably is too many.
One thing I want to double down to Alana's last point is like just like the professionalism preparedness. I'd say like the vast majority of our peers are lazy as shit. And therefore, like the more work that you do on your end to help our peer set educate ourselves on your business, the higher likelihood it is that you're going to be able to raise your round. Like actually for our seed portfolio companies, before they raise a Series A, I tell them to write their own investment memo and just give it to the Series A investor. And I kind of write half it for them, if not more. And like, just by doing that work, like, okay, think about the Series A investor, they have to write a memo. They have to sell it internally to their own committee. And if you're doing that work for them, you've now increased your chance of like getting capital like from 5% to like 25%. And so I do think most of our industry is lazy as shit. And so doing their work on their behalf, I only think increases their chance. And also like you should be better at understanding your business, your category, your market than any of us anyway. And so if we do it, we're actually going to probably do worse of a job than you will at pitching yourself. Now there's some categories where Alana's an expert in and I'm an expert in, and we probably will be just fine, but the broad strokes general investor won't be. And so just try to give yourself the highest chance of success in that fundraise. I think that's important.
So let's move a little deeper into the funnel. And this is also like some of the other questions that came up. You now have some angels who have signed up for your round, and there's one venture fund who is really interested in joining the round. You know that means that there's going to be more diligence. It might change the terms. It might change the size of the round. You need to keep the angels on the boat. And yet you're kind of thinking like it might be cool to have this venture fund, and instead of raising $1 million, maybe I can raise $2.5 million, and that enables me to do stuff. How should you think about that trade-off, especially in a market which might be, and this might be maybe our next question, deteriorating?
I'm going to let you go first.
Sure. I think like when thinking about how much you want to raise, you actually want to figure out like what's the milestone. And so let's say you're raising a seed round. To me, the question is like, what does a Series A investor want to see from whether it's metric wise or whatnot? And you figure out, okay, that investor, let's say they only care about revenue, which I don't think they would, but let's say they do, and they said you have to be at 1.25 of revenue and you're at 0. The answer to me is how much capital do you need to raise to achieve that goal in 18 months, we'll call it. That should be the number you're looking to raise. Like one of the things actually I don't like is when a founder asks me how much they should raise. Now I can tell you what you should hope to achieve from a progress standpoint, but I shouldn't necessarily be telling you what you need from a capital perspective. And so I think that's how I would articulate the round amount size to choose from. And I think like if you got like those angels on board, chances are you know them really well. They're bought into your business, and like if it takes you another 3 months to raise your round, they're not going to go away. In fact, you should leverage them and say, hey, who should I be talking to? Because you get my business. You probably know folks that write larger scale checks that also will get my business or actually just believe in you. And therefore make sure you circle them around and get them on board. I would almost, it's tough. I mean, on one hand, I could say like, just wait for that round to get done by the institutional investor, but like, there's no guarantee they're actually going to invest in your company. So that's a very, very big risk. The other side is you close some of the capital with those angel investors, but then you have to make sure you're doing it at a price point that's not astronomical or a price point that makes it impossible for then a larger fund to want to do your round. And that can be tough. Yeah, it's a really tough point given that it's so hard to raise capital right now for a pre-seed or seed stage company that like the risk of punting on like, let me see that bigger check is like scary. If I was in your shoes, much rather I would do it either, honestly.
And when you say like, if you wait 3 months, the angels aren't going to go away, because we talked a little bit about August of 2008, September of 2008, they did. In March of 2000, when we did our first Venture Crush, they did. In September of 2001, they did. In February, March, April of 2020, they did. And in 2022, they did. And there is also an art form to managing the communications if you're putting them on ice for a little while so that you can change the terms or add someone into the deal. And what you can't do is stop communicating with them just because they're committed already.
Yeah, I think you can also just do like, not price it, just say it's a discount to the round. And therefore, you've not priced it, they're locked in, and you've not put a price that will scare away a future larger investor. Things the other way I've seen it occur and be done. I also wouldn't do it if like you believe there's one investor that's like leaning in. Like you need a pipeline of folks leaning in. I wouldn't risk it on one person because that you just way too much risk on one investor that's already likely not to say yes in the first place, just because that's the math as well.
Unless that investor is equal.
Still, I think like you should never rest on like one institutional investor, regardless of it's who the fuck it is, honestly.
Yeah, I mean, just a couple. I agree, and it's a couple things to double click on because I'm just seeing this right now with a company I've worked with a little bit. I'm a mentor in one of the TechStars programs. Is often angels are less price sensitive, and this founder sort of let the angels sort of suggest a price, and frankly, that price was like much more of a seed price than a pre-seed price, and now they're having this exact same challenge that they are getting some institutional interest, and they're just not interested in that price. And anyway, there's a bunch of like hacky workarounds that everyone can do, and I see this sometimes also like if strategics come in who are also less price sensitive, and then they're trying to close out a round, and more traditional venture investors don't want to come in. So I think if folks are willing to do something that's unpriced at a discount, or even like if you a smaller safe that is set at sort of a reasonable price, and either I think like right now I'm seeing I don't think you want to have like a safe on top of a safe on top of a safe on top of a safe, but I think being very thoughtful about where you are pricing your angel money so that it is still attractive. It is still attractive for other folks. I think I'll also say too, look, like if there's a real shot at like a high signal fund, obviously everyone in venture wants to believe we're like, such like orthogonal different thinkers, and like we don't care if some amazingly high signal person is in a deal. The truth is like obviously people notice it. So I think there's also this example, we don't know who this mystery other fund is. I do think there is if you believe that there is meaningful opportunity for people who you believe are high signal, and sometimes like high signal doesn't always have to be like a venture fund, right? In many cases, if it's sort of like a healthcare founder, I really I respect and know and can reach out to, or something like that. I think that is interesting and useful, but I also think this is a time like everyone just needs to live to fight another day right now. And I think, not to say you should care who you take money from, because you're going to need to talk to them for a very long time. And so, don't take money from assholes if you can avoid it.
Yeah, but you don't know at the time.
You don't know, but there's some. I think talk to other founders.
You can sometimes you really do. You can definitely know, or you should be asking folks anyway, whether they're other investors, if you know them, or the founders or operators, because every investor has talked to enough people to everyone has a good signal whether they're assholes or not. Yeah. And then two, I think like. It's also about like signaling to the investor like the kind of partner you want. And so like if you only care about price, that's fine. Now the way that maybe Alana and I would read it was that like you actually don't give a shit who the investor is. You just want some money. And that's fine. It's really fine. But that may not be the founder profile that Alana and I want to work with. And that's something to think about too. And so just that this trying to seed in your mind, I guess, like what the investor is thinking when seeing price maximization, price optimization. Once again, I don't think it necessarily is a bad thing. If you're like, I've got committed to my business, my previous investors all sucked at providing value to me. And so I'm also just trying to price seek. That's perfectly fine. Now you get to execute on your own. Now think about that. But just want to make sense of how like we would view certain behaviors or responses to round sizes, valuations, dynamics as well.
And if you have, so in another situation, we have a term sheet. We're talking to other investors because we don't like some of the non-financial terms, right? And maybe the non-financial terms are rough enough that we're wondering, is this person or is this group going to be a good financial partner to us? How long can we keep that term sheet, that opportunity alive as we rapidly talk to others to try to get a more palatable deal?
It depends on the firm. Like for us, like I'm not hanging around for 3 weeks. Like my viewpoint is that we've spent time together, worked hard. I think we both understand how we can be helpful, what you want to do with your business. And if I haven't proven that to you yet, and you still need another month to talk to the folks, then like I'm clearly not the best fit for you here. I've lost, and that's fine. And so like I'm not saying, just to be clear. Now you can come back and decide other things for sure, but like I'm at that point, I've moved on to other deals and happy to re-engage, but I'm not going to wait and see how things are playing out in your mind, because generally that's mean that you want to optimize on things that I've, for whatever reason, have not optimized for you. Maybe it's price, maybe it's something else. It definitely won't be those terms. Like our term sheets are as basic as they come, but I do know folks that do wait around. And so it's very firm and fund dependent, but like I wouldn't be waiting around personally.
Yeah, I mean, we, given our check sizes, we don't lead as frequently. So, we are more often price takers than price makers. So we see less of this. Much in the state, like, I don't like it on either side, right? Like, when we also would not wait around for 3 weeks, but we also would never go to a founder and say like, you have 48 hours and this term sheet is going to like completely self-destruct. So, I think, much in the same way that, especially in this environment, frankly, when founders are like, you have 12 minutes to make a decision. And I'm like, really? So, I think, but, as an investor, when you get the sense that your term sheet is being used for them to shop around for better term sheets, like you will remember that for a long, long time. And like, we lose some and we win some, but I don't know if you have any specifics. I mean, I do think like, look, we're seeing people put terms into term sheets that we didn't see as much of a couple years ago. This is more in the later stage rounds that our founders are seeing now, right? That have, liquidation preferences or, that have other terms. And, I think frankly, the question is just like, are you a price taker or maker on your deal, right? Which is like, there's some companies right now where there is only one term sheet there and it's like existential and they want to live to fight another day. And as long as none of the terms are like so egregious, I'm seeing folks taking them. But I think, I think part of it is also being really clear about what you can and can't live with.
Yeah. I think too at the seed stage, I think there should just be nothing that's egregious anyway. Like at the stage, I'm not sure what stage everyone in the room is, but like if you're at the seed stage, it shouldn't be anything that's like ridiculous anyway. I think the egregious terms come into play when like you're on like your second or third bridge at the earliest stage, but most likely you've raised subsequent rounds and you're much larger to kind of warrant the structure. Like I know we have one of our, I know there's a company where there's like, it's a down round. And by definition, a down round has structure. And so like, that's, I think the scenarios where that comes into play versus like you're raising an institutional seed for the first time. That should be as vanilla as they come. If not, call Ed to make him fix it.
And let's talk about down round, which literally just means a round at a lower price per share than the last round. And because so many people used safes or convertible notes, but mostly safes rather than pricing the earliest rounds, they aren't technically down rounds, but they are definitely below expectation. And, when people so safes, for almost the entirety of the existence of safes, we've experienced an up market. Safes are great up market early stage devices. They are not great down market devices. They are not great late stage devices. And it's a bad idea to iteratively stack them on top of each other, because when you convert them, you have to convert them into different sub-series of preferred stock. I'm happy to talk about the math as to why, but you do. one of the things that happens is it's not technically a down round, but we did a SAFE with a valuation cap of 15 million. We're now doing our first institutional round. We've landed a great investor, and the pre-money valuation is 10 million, which normally we'd be excited about in this market, but now there's a problem. That's, one issue. And it comes up in the context of a question that we had in the room earlier. One of the companies raised a pre-seed round in November of 2021, which means champagne bottles were popping. It was so peak that there was no diligence, which fiduciary duty be damned. And now they're going to go through their first fundraise where there's actually going to be diligence. How do you deal with that? And they know that the price will come down because even though they've made progress, it was mispriced and under diligenced the first time.
Maybe a couple of thoughts. I don't know what this company.
Also, they said you're an investor. No, they did not.
Perfect. So I don't know what this company is or does, but I'm going to assume that, their books are decent and like they do great stuff. So I will take that as the assumption. This a little bit goes back to like the professionalism we were talking about when we look at fundraising materials and what it looks like to show up like ready to meet with institutional investors. I think just as a side note, especially for us as like first time female fund managers, we take our fiduciary duty extremely seriously. And the idea of going into a round where we did no diligence is like against basically every fiber in our being, especially for those of us like, I want to raise an awesome fund too. And so some of it's like, I'm not in any of those rounds. But so I think one is to say like, get your stuff in order, like have a data room that looks like you are ready to come play ball, that you are not hiding numbers. And, I think down rounds suck. Like there is no getting around it. It brews, investors are not always thrilled. It hurts, and so I think some of it is like creating room for that. It's a crappy feeling, but it's better to, like I said, to live to fight another day than to go down with the ship, try and get a 30% premium on your last round. And I think some of it is, look, I think right now is a pretty good time to be having pretty honest conversations with people. Like there's plenty of your investors you'll be talking to for that seed round who are way overpriced deals themselves, and I think as long as you are actually able to show like meaningful traction, meaningful progress to goal, and sort of useful reflection on how the first round went down, like I'm super open to hearing it. I think, when I see defensiveness and I don't see any numbers or like a sort of prepared, I want to see that you are prepared to go into this fundraise in a way that looks very different from the last fundraise. And I think, and also hopefully your pre-seed investor should be helping you get ready for this round and should be helping you pull together an investor list, that makes sense for you.
I think I agree with all that. I think the only thing I add there is that picking that previous investor is super important because they can maybe be helpful. And, the last round is priced really high, but let's just do a bridge at the same price to give you more time to grow into that valuation that actually does end up being like a really subsequent down round. Because beyond like your cap table being annoyed by the down round, like employees can see it quickly too. And around the company will dissipate very quickly when they hear of down round. They see their equities now worth a lot less than it was 9 months ago. And they're like, yeah, I was getting calls about these other jobs before, but like I liked it here. And now it's not so hot here. So now I'll take those calls. And so like, that's why I like setting up each fundraise in a longer term thinking viewpoint is super important because if you optimize on price now, you actually risk losing the whole business later rather than like perhaps picking that part that you thought was better, but couldn't come up by, 25% more. Because now you've created a lower baseline for you to achieve the next goal and get that up round or even flat in a market where things are being repriced. So I think like we've seen lots of companies get crushed that way. And particularly in this market, I've probably seen like at least 3 companies a week where I spoke to them 3 weeks ago. They told me the price of their last round. And I said, I won't come close to that last round price. And they said, cool, goodbye. Spoke to like other investors for 3 weeks and came back like, yeah, about that last round price, like we're good on that now. But like that's only a problem because of the previous round's price, right? And so if you had set up initially the right way, this wouldn't be a problem. Now, two, you could say, well, like every founder believes, like we do with our fund, we are exceptional. We're going to outperform everything. We can beat this mark for this next round and we'll execute. But like most of us don't, like Alana and I included. And so it's really, really hard to like set you up in a spot where there's no room for error to succeed.
But yeah, if you can do an insider round right now, I mean, do an insider round. Essentially, because to this point about like the more when people are, I think that I'm seeing folks put together decks that are in many ways like asking for the bare minimum amount of money that they actually need because it's hard to raise. Not starting from the mindset of like, what do I think I need to accomplish in this business to be able to raise the next round and walking their numbers backwards from that? Because in some ways, like, it's an even worse outcome to either raise a overly low price round that didn't give you enough runway or an insider round that gave you like an extra 4 months and you're still not where you need to be. So, I think like if you have a real sense of what your number needs to look like to get to whatever XYZ milestone, if you could fill that number with insiders, I think that's great. I think, some insiders will say like they want to see some outside signal, but, I think like the tough truth is that a lot of folks who have a lot of companies in their portfolios are doing, no one's fund model has money to re-up in every company that they invest in. The real is that fund models are built on, being able to re-up in just a smaller percentage of them. Like, and, I think the real truth is that people are running through those models in their heads of sort of, which are the parts of our portfolio where if we know we can only double down on, let's say like 25% of the companies in our portfolio, where are we going to do that right now? And so part of it is also giving as much information to your investors that help them want to double down on this one.
Yeah, and there is this commonly quoted wisdom of, don't take a multi-stage fund in your initial or your early round, because if they don't double down on you, the negative signal hurts you. And I don't really feel that way. There are a whole bunch of reasons why they may not double down, and investors ought to do their own diligence. And we see investors come into subsequent rounds where they really shouldn't, and they really should have called and spoken to the existing investors, and miraculously somehow they didn't, or they were persuaded, otherwise. But we see lots of places where, the person who championed the deal originally left, and the deal wasn't covered because it wasn't core for whatever reason. And certainly in today's market, I would not kick a multi-stage fund out of an early round, especially because and you referenced this earlier, in cold markets, there is movement in one direction, and in hot markets, there is movement in a different direction, which goes back to the initial question of like, when will pre-seed investors actually invest in pre-seed? And it's because they're investing in seed. And when will seed investors actually invest in seed? Because right now they're like looking for a round metrics, accomplishments, risk profile. And they can do that in a cold market. And frankly, they're still catching their breath from the hot market that didn't allow them to do diligence, and where they were tired of working really hard to win a deal and then, getting cut out of the deal or not getting the allocation. I do have a question that I promise you one of the founders asked. And I say that because I told them that that people would not believe that this wasn't my question. It was not a plant. The founder said that they had researched Springbank and they said that you invested in altruistic companies. So how do you feel about one of those companies being acquired by a buyer who does not share your values or the Springbank values?
Wow, that is specific. Are you sure you didn't write that?
You did.
At the end of the day, I have a fiduciary duty to my LPs to get a great return on the fund. So if there is an outcome that is great for the founders that I have been lucky enough to partner with, and for the investors who entrusted me with their money. I will, and again, like, if I don't know what this company, if this company is sort of, if it's a group of like active mafia hitmen, I might, I obviously would voice some specific concerns, but, at the end of the day, my responsibility is to my founders and to my LPs. I do think, and it's interesting too, because I think like, and I'll actually, maybe, can I say something about sort of investing in mission-driven companies and mission-driven founders in general, which is, like, that is the reason I get out of bed in the morning. There's just enough really big, hard problems that change people's lives to solve that I think could be like multi-billion-dollar outcomes. So like, why not solve big, hard problems? And I do think one of the things that's interesting as someone who spent basically my whole career in impact in different ways is that I think this is changing somewhat, but I sometimes get the feel from other investors, this sense that they think like impact founders are soft, like they're not hungry enough. They don't want to build a huge business. They don't want to like have a crazy exit. And I tend to find that the founders I'm most impressed with, who I think are doing the most high impact work, like you basically have to believe that you will change the world the most when you are a crazy sized company, right? If you believe that fundamentally the work that you do is impactful. But I will say, I think, I do see this bias a decent amount in different kinds of investors, this sense that, impact investors that, or investors that care about impact and founders that care about impact are somehow want to win less. Like, we don't. We actually want to win more because we think that when we win, everybody wins. And so we want it more. And I do think that like that is something that was really important to communicate. And like my partners have really different backgrounds than my own. So, which is part of why the magic works. But that was actually really important for us to communicate in our fundraise, which is that like, we don't think we achieve our mission unless we've had, a pretty amazing outcome on this fund. And similarly, when I hear from founders, like I want to know that they have that same hunger and like, believe that they want to make a bunch of money. And anyway, and I think sometimes it is a hard message to do both at once, but I think it is very possible.
I imagine as well that, that they're investing in these altruistic seeking founders, that founders is less likely to sell to a nefarious player in the first place. And so I think like the likelihood of it happening in the portfolio of yours is probably pretty low. And so, and then I wanted to push back too on one point you made or add to on the multi-stage firm. I actually think they are a huge ceiling risk. I think they are big.
They are a huge what?
Ceiling risk. I wouldn't do it. I think because like every multi-stage firm that I know, they do not share their best companies. If it was one of their best companies, you would not be seeing that investment. I would not see it. Well, I would not see it. Well, I would get $0 in that company. So would I. And so the fact that they aren't doing it is one of two things. One, you're not performing that well in their portfolio. They don't give a shit about you. Or two, they have a million of you and they didn't spend time with you. And so neither one of those are good answers to the question of why they're not investing. And that's what folks are going to ask. Now, is that going to be the sole reason why someone will pass? No. Does it make your fundraise harder? Absolutely. And fundraising is hard anyway. And so why make it harder for yourself?
And
and I would also just pressure test. I think like the nature of multi-stage funds, I mean, they have so many companies. And, I think like one thing I've seen both in companies in my portfolio and outside of my portfolio is, multi-stage investors typically are going to offer their most useful and productive relationships to like their later stage companies where they have sort of a lot more equity and value in. And so, when a pre-seed company is saying, Fund X is going to introduce me to every hospital system in America, I'm like, God bless. Like, I hope that's true. I don't think they will. And that often proves to be the case. So I think some of it is, I think this is also part of what's great about being in a founder network is it lets you do more diligence. Like I expect that and trust that any founder I've invested in has diligenced me and has diligenced my partners and like knows what we're made of. And I'd expect, so I think it's just sort of worth doing too, especially like whether a multi-stage fund or any fund of getting a sense of, if you pick 3 founders at random in their portfolio and they're like, I haven't heard from those jerks, it's worth spending time doing it.
Yeah, I think there's a story I heard from Fred Wilson at USV. He doesn't do this anymore, but he used to back in the day, where he had like a almost like a Price is Right wheel board in his office, and like each slice on the board was a portfolio company, and he was like, spin the wheel, whatever founder it lands on, I'll give you his phone number, her phone number, and like it means even the shit portfolio companies that probably had a bad experience with them, they were calling. And like, that is really confidence in like your ability to be helpful to founders regardless. And so I'm not saying we do that, but like, that's the kind of like investor you want to be working with, where it's like, even in the scenarios where they probably had a really, really bad exit, come into zero, lost all their money, or had to fire a CEO, all these bad examples, like, you want to hear about those too and how they react. And yes, like certain times that's the right answer to do that, but like, was it done the right way? I think is the important question.
Well, there are definitely situations where an investor has, fired a CEO or done something with the founder, or where the founder has left the company, where the founder will give a really terrible reference on the investor. And the problem in that particular case is the founder. And I have certainly seen those issues. And sometimes they involve embezzling. Sometimes they involve sexual harassment. Sometimes they involve, all sorts of really, really shitty stuff. And it can be a little challenging. There is someone who, said, and I haven't heard people talk about this a lot lately, but if you look at the companies that someone erased from their LinkedIn, those are probably good reference phone calls to make. But
yeah, I think if you work in any industry long enough, like, there are people who don't like you, like, period, full stop, everyone in the room, us on stage, etc. And so like, you can find stuff, you want to find stuff. The question is like, how nefarious actually is it? And like, how helpful and so forth can you, because like, there's always folks that just don't like working with Alana or Richard or whatnot.
Which is the same thing about, there is a spectrum on which someone might fall. Correct. If they are the buyer of your business. And if you invest in a company that's distributing mifepristone and someone is going to buy it to shut it down and pay a premium for doing so, then I could make a great argument why, as fiduciaries, you are right to say no to that. In fact, my partner Meredith Bouchot, who's in the back of the room, and Alyssa Frederick, who's a partner in our Silicon Valley office, and I co-authored an article about why it is actually consistent with your obligations as fiduciaries to invest and say, we're going to expand the company's access to reproductive health care and abortion care for their employees. And in fact, like, we're going to require that for follow-on investors and for acquirers. So there are ways to kind of keep that in, because it's a spectrum.
And also, I think like one of my lessons raising our fund one was, like, I can't be any different than I am. If I try to be kind of like a straight down the middle PE dude who has zero political opinions, you know what? I'm not going to do a very great job of, I will be a very mediocre version of that. And you should actually invest in that person. And, I think I'm really stoked that we ended up with some really major institutional LPs who liked our version of who we are, and that we believe that our mission is magnet for founders and capital. And that has proven to be true. And I think about that too with a lot of the companies we're invested in, which is that, and obviously now the labor market is changing, but in a really tight tech labor market, part of why, they were pre-seed companies who were offering not competitive salaries, why they were getting engineers that were ridiculous, was because they wanted to work on something that mattered to them. But I also think that when you choose that path, there ends up, I think there's often more scrutiny on founders who are underrepresented. I think there's often more scrutiny on founders who are sort of doing something mission driven, when you maybe mess up and do not do something that kind of follows that path. So I think there's also sort of a business element as well of, if a core part of, how you've been attracting your talent over the years and potentially attracting customers is, in some way mission driven, I think protecting that reputation at all costs is pretty important.
So we're going to do 2 more questions from me, and then we'll do 1 or 2 questions from inside the room, and then we'll close. You mentioned something about the Hunger Games when we spoke last week. Do you remember the context for it? Do you want to talk a little bit about it?
Yes.
It goes to the mission-driven piece too.
Yeah. So, one thing that was important to us in the course of our fundraise was we did not take a lot of money from folks who sort of were just interested in backing, diverse fund managers. We have some of it, and the ones that we have, we're very proud of. And I think part of it was, in part because for so long, so few underrepresented fund managers have raised meaningful sized funds. It's a real scarcity mindset. So I was, what I was saying to Ed was that, sometimes some of these pools of money had like a real Hunger Games feel, like, okay, tell us why you are better than this Black-led fund. And it's like, I will literally never do that. So, when in fact, first of all, judge all of us on our performance, but that also, when we come to believe that, there were only going to be these small pools of money for each of us and we all had to fight it out, like, that is not a great place to be. And frankly, especially because some of those pots of money cropped up, after George Floyd's murder and the subsequent, apparently all of a sudden, folks who had not maybe been in a movement, in the movement around these issues sort of were coming aware. The real is like, as a GP who's going to need to raise another fund, we also like having LPs who are going to back us in a fund 2 and a fund 3 and a fund 4. And a lot of these pools of impact, sort of impact capital for diverse managers, it's pretty clear to us that it had kind of sprung up due to current events, and there was not a lot of commitment to that money doubling and tripling down, which is what we look for in our LPs.
Fundraising is hard. I would take the money, period, and figure out a way to solve it for later on. I think just because the pool is different doesn't mean the group of person you're getting from is any less quality than, not saying you're saying that, than anybody else. And so like, fun run, I'm not sure you guys, us, really hard, sure, same for you. And so like, as long as you're not like that nefarious character we discussed before, like sign me up.
Last question for me. We're getting toward summer. Summer has historically been a time when, I guess in August, if you shop your term sheet, or if you shop for a term sheet for your company in July and people shut down, or venture funds shut down, particularly in a slow market, take a breather in August, and you are still on the shelf looking for those first meetings, you look a little long in the tooth, a little tired. How do you manage that process? And even without the pending summer break, if there is such a thing anymore, although Richard, you said all of your peers are lazy, and they'll quote you on that.
Yeah, you can quote me.
How do you kind of pre-market without, giving, in a way that gives you a little more shelf life for your fundraise, because you need time?
Well, I think people do rounds in the summertime, so I think you can raise capital there. So I don't think it needs to be just pre-marketing only. I think you want to make sure you're talking to the right person at a firm. So back to those like multi-stage firms, you're talking to like the junior person and the senior person, and you probably have a tough time getting that close because they need to get support from someone that may or may not be available. Not saying you shouldn't talk to them. I think they're super important because they are the ones that drive the work to get to yes in the company, but just knowing who you're talking to and where you are in that funnel is important. I think the pre-marketing piece there that you mentioned, Ed, I would, if you don't have to raise money, sure, wait till the fall, Labor Day, et cetera, and use that time to talk to like 3 folks that are either friendlies to you or friendlies to your existing cap table members to get a sense of what they want to see in you as a company that's looking to raise a seed round, a series, whatever it might be. That way, you know what you need to go to accomplish in the next quarter or 2. And so I use it kind of as like a, because, back to the last point around like, hey, this like phantom term sheet, people are always like, but you're not raising money, you're talking to me? Shit, like this must be important. Let me like really spend more time and attention. So I think if you can like start to have convos when you don't need money, it just like creates FOMO or excitement for whatever reason amongst the investor base. And 2, it also gives you time to understand and learn whether like Richard or Lana or Ed are assholes or not. Because like they can say, hey, I'm going to introduce you to every health system in America, and they do 0. Well, now like they've done no real help prior to investing. Their behavior probably is not going to change post-investing either, honestly. And so having a runway to kind of test out and validate the likelihood of someone being helpful or not, I think is super important. And it goes both ways too. The investor also likes to have more time to better understand, like, hey, you said you were going to accomplish X, Y, Z in the next quarter or 2, and you got none of it done. Like, that's a pretty good signal for me. And so I think it's a good time to start building a relationship, even if it's a quarter in advance. You don't need that much time in advance, honestly.
Yeah, I mean, I think maybe we're on the short list of VCs who will be working this summer. I think like July is,
Guitar Hero and work.
July is less of a disaster than August, but I do think, and also one thing too, to this point about who you're meeting with, because I think he's exactly right that like, obviously if you've only spoken to a handful of associates at a firm, like they cannot write a check. I will also say too that like the associate VC network is very powerful. They constantly are sharing information. I learn more from my associate than most people I know. And so I will also say too, I think especially, when the market was hotter, I would see some founders treat associates in a way that did not make my heart sing. And like, I remember that. And I get it too, right? Like sometimes at bigger firms, there's associates who are kind of poking around for metrics that they might not be serious. So there's a give and take of like feeling out why you are in conversation with that person. But I will also say too that, like having informal relationships with VC folks who might not be check writers, but who you're like grabbing drinks with and can just kind of give you the lay of the land of like what they're hearing and seeing, and frankly are going to be working in July and August, is useful. I do think, I think that there is this sense that, when you see rounds where it feels like you've seen the deck and the founder kind of multiple times over a couple of months and the rounds are just not closing, like fairly or unfairly, I think, people like to feel a sense of momentum. So, I would say at this point, what is it? Is it the middle of May?
Yeah.
Okay. I think if you're already in process, I think, look, like plenty of deals are going to still get closed at the end of June and the end of July. I think if you have not started your fundraise at all, I think, thinking about how do you build your investor pipeline and materials now so that you're really ready to sort of kick off in September, is going to be a good idea if you have not already sort of gotten a decent way through the process by mid-June, if I had to guess. But.
All right. Are there any questions in the audience?
Yeah, there.
Do you want to start with? Did you just?
I was just saying there's plenty. I'm not sure which one to start with.
Chance.
Thank you for doing this. Say as founders, we break around and then we would not be growth expectations.
Mm-hmm.
How will your best investor treat you, and how will your worst investor treat you? And then maybe how do we behave with our investors?
Mm-hmm.
Want to repeat the question when you answer?
You want to repeat it, you said?
Repeat it when you answer.
Oh, sorry. Yeah. So the question was effectively, you've got a plan in place. You're not hitting plan. How does a good investor and bad investor respond to that? I would argue that 85+% of founders are that scenario all the time. So the plans are rarely hit ever because they're outrageous plans, but we're trying to swing for big things. So I get that. I think like the good investor just tries to understand, hey, why are you not hitting plan? Is it because the plan was never achievable? If so, that's honestly fine. If it was never achievable and it wasn't a strong growth plan, different kind of question, but you probably already agreed on the plan in the first place. Third, I think it's understanding how they can be helpful in determining that. Is it, hey, it's actually you're selling to the wrong internal buyer? Is it you actually don't have product market fit? Is it there actually isn't enough ROI tied to what you're building or selling? Mm-hmm. And so all those things I think are what the good investor would do. The bad investor, I'll give two answers. The bad investor, the best thing they would do is do nothing, honestly. The bad thing they can do is berate you, not be helpful, leave you to be dead. That's these things happen. I'm not making shit up here. And so I think the real investor tries to dissect what was the root cause, because the root cause just could have been the plan was never achievable. And the company's still doing quite well. Mm-hmm. Or it could be, hey, we need to think about pivoting. And so it's more of saying hey, I'm along for you with the ride. Let's think through together with everyone we can to figure out the answer, rather than abandoning you. Because yes, I do have 20 other companies I could spend time with, but each of them matter. And a company in my portfolio is more important and valuable than a company I'm looking to invest in, because it's a company that I have an equity stake in right now that, if solved for, can be meaningful to me, rather than finding some other company that I don't know anything about at all.
Yeah. Agreed with all of it. One thing is don't be cute with your numbers. we can always find sort of a metrics like, well, if I cut, like attributing things that are not actually recurring revenue, or, like, look, we can all do fun, as discussed, many of us are professional backgrounds where we can do funky things with numbers. And I appreciate and admire when a founder's like, here's what's up. And, or like I had a founder where like they realized they had a data problem. They had like an attribution problem and their numbers weren't as good as they thought they were. They weren't off by that much, but like they just sent an email to all the investors. It was super clear. Like I could see all of the numbers in it. And it gave me a lot of confidence in the team. So I think like, if you want us to be your advocates, I don't want to feel like I'm going on a detective mission to understand, what's going on. I think in this environment, some folks are just going to feel like I don't have capacity and they're going to drop folks and like not be super, super responsive. Obviously, if anyone is berating you, then that seems really bad. But you're trying to give folks the ammunition to be on your team, instead of, making us feel like we're sort of on different sides of the table.
We'll take one last question. Go ahead in the back.
Well, first of all, thank you so much for doing this and acting on this. I'm thinking a lot about capital infrastructure, highways. Okay, so right now I've been up there saying every single dollar out of everybody and invested in. And from my institution, I would like to see that they can help with the next. I love people that are willing to fight it, because not digging, not helping. What is your thoughts about that part of investment relationship?
To make sure I understood the question, was it like, how should a investor help you as a subsequent round, or what's the actual question? Sorry. First.
So how you can help your portfolio companies raise the next round? I mean, it's a whole range of stuff. Sometimes, we're in there with them, like getting their materials ready, workshopping the deck. Often, either like the lead investor, but I prefer when the founders themselves have put together a spreadsheet that's kind of like their tracker of who they want to go after for that round. And they will typically, we'll work with them and with the other funds at the table to kind of assign out like, okay, who already has a close relationship with this partner at this fund. And, I think giving people clear marching orders versus a sort of expansive, like, who do you know? And when I think it's been really helpful when founders have said, okay, we think like this is the kind of firm that feels like the right firm for us. Here's like 50 firms we're targeting. These are the partners we think are right because we have like actually looked at their list of investments and this feels like it's in their sweet spot. And then that way, all of the investors around the table can sort of quickly like page through their phones and LinkedIn and see which of those 50 partners, who has the closest relationship, and we'll all collaboratively kind of put in, okay, like Alana will take first pass, Richard will contact this person. So some of that stuff is helpful. And that's more of like the administrivia stuff. And then I think there's also sometimes like just the collaborative and sometimes in this environment, hard conversations about, valuation expectations and, getting people ready to face this market when their last experience of raising might have been like, woo, party, confetti. Anyway.
Yeah, I think I read that. I go back to like helping the founder have that professionalism with the fundraise. And so, a founder fundraises maybe once every like 18 months, maybe. And we look at fundraisers every single day, multiple times a day. And so we've got more data points there. So I think like knowing what like is required from the founder side and sharing that and helping them create that, I think is important. Two, I think the firm matters way less than the person, which I think Alana was like alluding to with the LinkedIn thing. And so like, I may know that Alana really likes to see X, but Rich likes to see Y. And so that might mean like two separate decks with two kinds of investors to optimize the success with that overall fundraise. And then I think lastly, it's like Alana and I are the investors, like pre-shopping the opportunity for you. So it's like, hey, like I know you like these kinds of companies, and so you should keep company A or B on your radar. And so when your investor is talking about like a certain company frequently to other investors, and you say, hey, they're actually raising now, like they put it at like the top of the list. Like Alana talks about one company all the time. This is the one company. I would meet them as much as possible and move as quick as possible. And so, and then the other thing I think we can do too is also just like tell you the truth on what's happening in around dynamics. So you may be like, Equal is like hot on our trail. Alana's like, I talked to Rich. He doesn't give a shit about your company, actually. So like you read him completely wrong. Or it could be like, we think we're at the tail end of the process, but you're not actually there. And so those are things that we can ask our peers, and they'll be more truthful to us than you. Or like, 7 companies passed, and they told you it's because like the market size, but actually they told us like, hey, like I think the founder was that great, or what it might be. And so we can be more honest with you than they can be, but we can get that data, relay it to you, and then share how to best position yourself for the future fundraisers. And lastly, I'd say like I always do a like practice pitch with our founders, and so I pretend to be an investor that doesn't know anything about their company at all, and so I'm asking like questions that I think a new investor would ask. And so obviously I know the answer to the questions, but helping them prep answers to those questions that may be basic, I think are also super helpful.
Yeah.
Thank you both so much, and thank all of you. So a couple of quick closing notes, and then hopefully folks will stick around and network a bit, and we will have drinks for you. I want to thank Tolu Adateo and Ron Feingold, who did research, especially on air guitar articles, which is always the goal. I want to again spotlight the Women in Venture series by and for women that our partner Meredith Bouchaw, who's a tech M&A lawyer here in New York, has been spearheading over the last year, and those are great events. Next one is on June 15th. We have another one of these on June 22nd. I should also mention that we just brought in a big group that represents some very well-known family offices and endowments and foundations, and that group is headed by Beth Shapiro-Kaufman and Megan Warnke, and Beth was running that whole part of the IRS for half a dozen years. And we also brought in the former chief judge of the U.S. District Court for the Federal District of New Jersey, who spent 36 years on the federal bench after having been an associate right here at our firm. So delighted to have Judge Freda Wolfson, Chief Judge Freda Wolfson back, and also delighted to have Barry Albin, who was a justice on the New Jersey Supreme Court, join us after 20 years and more than 400 opinions on the New Jersey Supreme Court. And Justice Albin has written a number of landmark opinions on civil rights, including New Jersey's first opinion, Lewis versus Harris in 2006, where writing for a 4-3 Supreme Court, he endorsed the rights of same-sex couples, which was groundbreaking. So we're very excited that he is heading up our appellate practice. So that's a little news from around here. And then I just want to thank our amazing Venture Crush team, Carrie, Angela, Karen, Brittany, Owen, Jenny, Ariel, Ginny, without whom these events don't happen. Thank you all. Thank you so much, Richard and Alana. Thanks everyone online.